Good morning. It's Jeffrey Christian of CPM Group. It's about 11:20 in the morning of Friday, the 2nd of May here in New York. I want to talk about the precious metals outlook. We've seen this week data on for the first quarter, the first flash estimate of first quarter U.S. GDP in the United States. It came in as a negative 3% contraction of the GDP, but it's a very complicated situation that's going on there. We're also seeing other data from other countries, and it's very mixed. Some other countries, Canada, for example, are reporting contractions in their economic activity, their real gross domestic product. Other countries are showing somewhat stronger growth than they had expected, although not particularly dynamic growth. There continue to be a lot of problems going on in the economy globally, as well as in individual countries like the United States. And some of the policies that are being pursued have are likely to exacerbate that. We have been talking about a recession possibly in 2025, but 25, 26 most likely. We have increased the depth of the recession that we are projecting, given some of the changes in government policies as well as real economic supply and demand. But it's a very complicated situation. So this is real GDP percentage change from the preceding quarter. And you can see that, we've been bumping along. We did have a weak quarter in the first quarter of 2024. I believe that was weather related a lot. But basically, we've seen GDP in the 2 to 3% range. We had a negative 3% in the first quarter. Now, that negative contraction was due to heavy imports in advance of tariffs. Imports are subtracted from overall economic activity. And so that was a negative, pulling it down and showing negative contraction of economic activity, which probably isn't really necessarily the start of a recession. It could be the beginning of a recession. We're going to have to see how economic activity continues throughout this remainder of the second quarter into the third quarter. Our expectation is that things will deteriorate, but this was a little bit sooner than we had expected, and that reflected the fact that you had a lot of people bringing in goods into the United States in advance of expected tariffs, which weighed on overall economic activity. It also, I'll show you some personal consumption expenditures data in a second, because that also came out this week. What we've seen is that demand was brought forward into the first quarter and into March by investors buying automobiles and other goods in advance of expected tariffs. So that means that you're probably going to see lower demand in future quarters. In other words, the strength that you're seeing in some indicators now in the first quarter and in March and in April suggests that you could see even weaker growth in consumption and final demand in subsequent months and quarters. So it's not a particularly sanguine economic outlook. This is breaking down that first quarter real GDP by economic sector. And the orange thing all the way over on the left, if you can't read it, is the total real GDP, which was negative 0.3. Consumer spending was up a little bit. The big increase was investment demand, and government spending was off a little bit, although the deficit spending was something like $154 billion more than a year ago. Exports were up slightly, and you had this big 5% increase in imports, which is really the factor behind the negative 0.3 total. Now, I will say this, because I've heard some people question this. Gold and silver bullion imports, which were pretty heavy in February and March, are not included in imports. There is a small portion that is included in imports that is estimated to reflect actual fabrication demand for gold and silver. But most of the gold imports show up in investment demand because that is, in fact, where the metal is going. It's not being used in fabricated products, it's going into investment demand. So the investment demand figure partly reflects the increase in gold and silver imports for investment purposes in the first quarter, and the imports does not include any significant amount of gold and silver imports. Just so you know, in case you hear otherwise. Turning to the personal consumption expenditures figures, you can see the big increase, 56.6% increase in March in automobile purchases, autos and auto parts. That is people buying cars in advance of tariffs that might disrupt production or will disrupt production or would disrupt production if they occur. And the availability of vehicles and the likelihood of sharp increases in automobiles. It also reflects auto manufacturers and auto support industries bringing in parts for servicing and repairs in advance of anticipated tariffs. So the big increase in consumer consumption, personal consumption expenditures was in automobiles and auto parts. The great, the Bureau of Economic Analysis shows services in gray and goods in orange, and you can see that recreational goods and vehicles were up 8.6, non-durable goods were up 7.7. You were seeing some people stock up on things. A lot of the services continued to grow. And then gasoline and other energy products fell because you saw the oil price decline in the first quarter and into March compared to where it had been. We had been hovering around $72, $73 a barrel. Gasoline and heating oil commensurately related to that. And then the oil price fell to about $62 a barrel, and gasoline and heating oil fell equally. So this is the disposable personal income. The blue part is the actual percent change in disposable income. The orange part are the outlays or expenditures that people make. And then the black line is the personal savings rate. You can see the personal savings rate been relatively stable, around 3.2 to 4%. The consumption, you can see in November and December, exceeded the increase in disposable income. And then in February, you saw disposable income actually rise at a greater percentage than expenditures. And then in March, again, you started to see people spending more money in percentage term increase than they were making in terms of percentage term increase. And then this is the PCE, the Personal Consumption Expenditure Price Index. And you can see it's pretty much largely unchanged. We saw a little bit of a decline in March from February levels in the PCE, excluding food and energy. But basically, they've been pretty much largely unchanged over the last 24 months. PCE price index gets a lot of attention because the Fed has said it feels that is a more accurate measure of consumer price index than the consumer price indices. I'm not quite sure that that's true, but I have known people who have worked at the Fed on inflation data, studying it, and I'll take their word at it because they have spent their lives and careers looking into what this data really means. Turning to the markets, gold prices and silver prices fell sharply earlier this week. They fell basically on some relaxation of market concerns over the imposition of tariffs and other economic factors. You saw earlier this week some pushback by some of the courts on some of the things that the Trump administration is doing that are considered to be destructive of economic activity and economic value. You also saw continuing wavering about what tariffs are and what they'll be, and we're going to change this, we're going to change that. And you also saw some changes in the international political and military front that led investors, generally speaking, to exhale. CPM grew, and in that environment, you saw gold and silver prices fall. Now, gold fell to around $3,200. That was the highest level that you'd ever seen prior to April of this year, right? So the gold price is still at record levels, even though it gave up almost $300 or roughly $300 briefly. It sprung back today. There's a lot of volatility there. Even though it gave up $300, it was still at prices that were record levels prior to April 2025. And I've changed this chart. It only starts in January 1st, 2025, as opposed to January 1st, 2024, which I have been using. You can see the gold price was around $2,660 in the first trading day of January, and it has risen almost $900 to a peak 2 weeks ago. It's come off and started to rebound. CPM Group's expectation is that the price could move sideways for the next few months, but we still expect prices to rise and to make new record highs on an intraday basis. And we say that because if you look at the factors that contributed to the sell-off, the reduction in financial market concerns about economic and political and social issues, they're temporary. Yeah, the problems have not been solved. The problems have not gone away. The people causing the problems have not gone away. They will redouble their efforts and come back. This was just a pause in the assault on economic activity. And we assume, and we, every indication is that the assault on economic activity will continue and they'll be back. And that will cause financial markets to once again say, okay, I really should have more of my assets in gold and silver as protection against what's going on in the global economy, the national economy, my local economy, society as a whole, and political factors, both international politics and national politics. Things will stay volatile. Nothing's been solved. It's going to get worse. Gold, by the way, is, when I started this video 13 minutes ago, the gold price was $3,268.90, and that was up about $46.70 from yesterday's close. Silver, as I started this, was about $32.39. That was actually off 8 cents from yesterday's close. Silver has continued to be weaker than gold prices. We are now in the May contract. One of the things that we've seen over the last week has been a resolution of the role of COMEX silver futures from May into the July contract. So that upward pressure is off the market. To some extent, that role could be seen as having helped silver prices, which fell very sharply in the first few days of April, recover, having spiked down as low as below $28. Prices basically fell to around $29, $30. And the price rose back in the middle of the month to $32, $33. That's when a lot of the roll occurred. And the roll is behind the market. I'll show you some numbers here, which might help you. Open interest on COMEX silver futures contracts. At the end of March, 619 million ounces in the May contract. As of the 30th of April, that's the data that was released yesterday by the COMEX, we were down to 10 million ounces. So the roll is behind the market. Much of that has rolled into the July contract, which has gone from 152 million ounces to 555 million ounces. So stay tuned. But the roll is behind the market. We'll look at it because we got into first delivery. And at the bottom here, bottom left-hand side, you can see May silver contract deliveries. And again, these are deliveries of depository receipts. One company is short May contracts, another company is long May contracts, and the short one goes to the clearinghouse and says, here's, you have my receipts, I've registered them with you, I want to deliver into that contract. And then the clearinghouse assigns that receipt to some group that's long the next day. The short and the long are canceled out, open interest declines. And you see that. Now, on the first delivery notice day, on the 29th, the shorts said they were going to deliver 58.5 million ounces of silver. This is something that we've all known because we've seen it coming because of the imports and a lot of commentary. It's a very large amount. It's nothing that anybody should have been surprised about. And typical for the delivery of an active contract across commodities futures markets, a lot of the deliveries were in the first day. 58 million ounces the first day, 4.6 the next day, 1.3 yesterday, the third delivery day. So you had 64 million ounces of delivery notices, shorts saying to longs, here's my metal. During that period of time, registered inventories rose from 163 to 166 million ounces. Eligible rose from 335 million ounces to 334 million ounces. That actually was off a little bit. I stand corrected. And combined total rose from 498 million ounces to 500 million ounces. And that's because the delivery process is delivery of warehouse or depository receipts. It's not necessarily a physical metal that is being taken out of the depositories. That may come later. It probably will come later for some. Some of this stuff will disappear because it is going to be encumbered in other transactions backing ETFs or exchange traded products, or delivered to people who actually want the metal for fabrication or investment purposes and don't want the metal in COMEX registered depositories in the northeastern part of the United States. But for now, we've seen 64 million ounces of silver delivered in the May contract, which represents more than 10% of the total metal that's there. And much of that metal, virtually all of that metal actually, some of that metal may have come off, but it may have been replaced by other metal that was being delivered into the depositories and registered with the clearinghouse at the same time. The total amount of metal registered with the COMEX actually has risen. So, not a shortage in silver. As a result, you can go back to that silver price chart. We expect silver prices to continue to perform as they have. They are obviously vulnerable to another spike down, the way we saw in early April. The economic environment is such that it suggests investment demand will pick up over the next several quarters, but there could be pockets of weakness. Our overall view is that the price probably will stay above $30, $31, and we'll go up there and test that $35 over the course of the next 9 months, 8 months of 2025 into 2026, and probably move to new highs. Is it going to go to $100? No, it's not. That's not the way the silver market works. The silver economics of mine production, secondary recovery, fabrication demand, and investment demand all suggest that you should not expect silver prices to move above $35 and then skyrocket. If you see silver prices move above $35, they could go higher. They could go more than 10% higher in CPM Group's projections in our main scenario. But they probably are not going to get to $100 because the economic realities of the silver market, despite what some people say, just doesn't support $100 silver. Sorry, but that's the way it is. I'm actually not sorry. Platinum prices have continued to move sideways. They moved toward the high end of their range, and nothing expected surprising there. And palladium prices have underperformed platinum, but they're continuing to trade in their range. Platinum and palladium are extremely vulnerable to production problems and disruptions in the auto industry globally due to possible disruptions in the supply chain of components. So there's a great deal of caution right now about platinum and palladium prices, and there's not a lot of expectation of prices rising. And there's no deficit or shortage of platinum or palladium. We will be having our open forum challenge your assumptions internet session next Thursday, the 8th of May. If you are a client of CPM Group, you can plug in there and listen to the Q&A. We don't have a formal presentation per se. We're taking questions. We have already received quite a few questions, starting to go through them and organize them. And people who are clients can either send in questions and register ahead of time, or they can register ahead of time and they can ask questions during the session by typing them in to the question section on the platform. If you're not a client, you could go to our website and sign up and buy some products and become a client. In addition to the open forum on the 8th of May, we'll still do these videos. We will be releasing our Silver Yearbook in May 27th. We'll be speaking a couple times at the Society of Mining Engineers Current Trends in Mine Finance conference here in New York. You can get information online about that and sign up. It's a very intense, very professional conference that lasts 3 days. Absolutely excellent for real information about mining and mine finance. Murdoch Capital Partners is combining with OTC Markets and TAA Advisory for a one-day precious metals and critical materials conference that same week on the 22nd of May. That is a hybrid conference. There are people who will be plugging in remotely via video, and there will be people in the audience. The last time I talked to Murdoch Capital Partners, they had about 20 seats left in the physical thing. And then in June, we'll give a little talk at the Astrologers Fund. That's about all I have for now. Our Gold Yearbook came out in March. It's available online. Download it as an ebook. Our Platinum book will come out in late July. You can go to our website. You can buy the yearbooks. You can get information about the open forum. You can sign up as a retail investment client or buy other research. We have research that extends out 10 years, as well as shorter things like our precious metals and base metals advisories, which are monthly reports with 3 months and 8-quarter projections for the metals that each one covers. And you can send us an email at info@cpmgroup.com asking us questions about how we can help you manage your precious metals and commodities financial exposure better. That's all I have for now. Take care of yourself. Take care of those around you. Try to do something good for the world and enjoy the weekend.